All right. Good evening, everyone. Thank you very much for joining us this evening for the Insurance Recovery Webinar. My name is Richard Villanueva. I am a Vice President with the Greenspan Company, Adjusters International. I am also a licensed public adjuster. For those of you who aren't sure what a public adjuster is, we are licensed directly by the Department of Insurance, and our role is to protect your financial interests by preparing, presenting, and negotiating the insurance settlement and making sure that we hold the insurance companies accountable on your behalf. I want to make it really clear I'm not a professional speaker, so show me a little grace as we go through this. But also, this is not a solicitation. This is our way of giving back to the community. Greenspan is the very first public adjusting firm in California. We've been representing losses now for 79 years. And we believe strongly that this is an important time for us to give back to the community that has been so supportive of us over the years. With that, I'd like to just kind of jump in. We've got a lot of information to cover this evening. This will be recorded. Feel free to request a copy of this recording when we're done. And that way you have it to go back and play, because we're going to be going through quite a bit of information as we move forward. Common misconceptions, folks. I think this is important to start with because there's a lot of information in the Facebook and the social media apps that everybody seems to be a part of in the community. And the common misconception that we see across the board is the following: that you've been paying your premiums, you have a policy in place, your home is a complete and total loss. And that the insurance company should just step up and cut you a check. Now, in theory, folks, I agree with you 100%. Yes, that should be the case. Unfortunately, that is not how it always works. Now, I will say this. The discussions that we're having tonight is going to be a general overview of the claims process, coverages, tactics, in kind of a nutshell. But it will not apply to all of you because there are many of you who have received policy limits, and I'm not going to go into specific insurance companies as to who's doing what. Suffice it to say that we know that there are some that are paying limits and many that are not. So if it applies to you, great. If it doesn't, understand we're trying to kind of cover the masses here. So that is the common misconception. Just because you have a policy and you have coverage that they're going to come out and cut you a check for your policy limits. That is just not the case. You must prove to the insurance company the value of your loss. There is nothing that states that the insurance company need be accurate in their assessment of your overall valuation. You are filing the claim against the insurance company. Therefore, the burden of proof lies on you to prove to them what it is you are stating you are owed, and you must do so from a defendable position, which means documentation and alike. So just understand that it's your obligation to prove to them, not their obligation to prove to you. Second misconception is that your insurance company is being very cooperative because they're giving you large checks and they're processing these advances. Folks, they're contractually obligated to you. You need to understand that your policy is a contract. We don't look at them as policies. You engaged in the transaction, and in doing so, they agree to the terms. Should there be a covered peril, in this case, a fire, and you paid for that policy, which means you entered into the agreement and you agree to the terms of the contract you entered into. So they're just meeting their contractual obligations to you. They're not trying to be cooperative or uncooperative. They're just doing what they're supposed to do. And if they did what they were supposed to do, they would pay you all policy limits. And so obviously they're not doing exactly what they should be doing. So they are obligated to provide these advances to you against your dwelling, against your personal property, and against your housing. So please don't be seduced by the advances. They're not doing anything special. They're just adhering to their contractual obligation to you. What we're going to do next is just jump into some slides that cover the different coverages that you'll typically see in your policy. Excuse me, let me just move this little screen down here. And I think it's important that you understand how to best identify what your coverages are. I'm going to refer to them as we go through this as buckets. I like buckets of money as opposed to coverages. But each one of your coverages, folks, is applied to a very specific portion and a very specific part of your claim. Even though you have a single claim number, you have technically 4 claims running parallel to one another. each one having to be prepared, presented, and negotiated independent of itself. Because you have these defined coverages, they must all be presented independent. So we'll go through them quickly and then we'll go into more detail. All of you have coverage A dwelling. Now, of course, this is pertaining to those who have lost homes. Commercial policies are built a little bit different, but in general, this is for the homeowner. So everybody has coverage A dwelling, which is the stated limit that you'll find under your declarations page, which gives you the dollar amount that you see in your policy for your dwelling. Now, it's important to note, folks, and I'm going to skip through these fairly quick as we go, but your coverage A dwelling limit that you see in your declarations page is not the dollar amount that the insurance company owes you. That is the dollar amount that the insurance company owes you up to. And we're going to get into that later. So remember, that's what they owe you up to. You have other structures for visual examples. If you were to take your home and just plucked it off your property, what is left remaining on your property, pools, fences, decks, outdoor kitchens, separate structures, detached garages, things like that, fall under other or separate structures. You have your personal property, which I'm sure we all know that you're struggling with to some degree for those who haven't been paid policy limits. And then, of course, you have your loss of use and your additional living expenses. Individual policies label that particular coverage differently, which we'll get into in greater detail as we go. But those are the four basic coverages. And then now we'll start breaking down each of those coverages so that you have a better understanding. So I'll try not to get too far into the weeds on this, but when you have a loss of this magnitude and you have a complete and total loss, technically you have three options that become available to you. Now, this is all dependent on whether or not you have a mortgage, you don't have a mortgage. So in this particular case, we're just going to talk as if you don't have a mortgage, so you understand what your three options are. And then we'll kind of touch base if you do have a mortgage. Your three options are the following. You can rebuild on site and transfer all the proceeds that you get and all your provisions to that rebuild. You can rebuild anywhere else in the country and transfer those proceeds. You can choose not to rebuild and just take the money and whatever they offer you. And if you don't perform, you keep that money. Which we'll get into, or you can purchase a replacement property of like value minus the land. So again, if you have a mortgage, it becomes a trickier scenario. And I would encourage you, if you have any questions as to how you should move forward, we are providing one-on-ones with clients who have very specific questions, because it can become problematic if you don't understand how to navigate the mortgage. Does it make sense? Does it not make sense? Do you pay the mortgage off? Do you not pay it off? And that's a discussion for a different time. And I would encourage any of you, if you have questions, at the end of this, you'll have our contact information in mind specifically. And I'm happy to spend time with you and really break down individually what makes sense and what doesn't make sense. But in this particular case, we're going to go ahead and break it down a little bit. So based and buried in your coverage A dwelling, you have basic coverages, and your base limit in this particular example we're going to use is $2 million. The purpose of this slide is to help you better understand what coverages basically are connected to your coverage A dwelling. And so we'll kind of go down as we go here. Debris removal is typically 5% of your dwelling. In most cases, I know a lot of you are questioning, should I opt in? Should I opt out? Let's just handle this question real quick right now since we're on this debris. If you have items on your property that fall outside the scope of what is going to be included in your debris removal program, then ultimately you are going to be held responsible for those financial obligations. And there will be expenses assigned to that particular piece of the property that is not covered under your debris removal, i.e. pools. So for those of you who have pools, if you're saving your pool, if you're not saving your pool, whatever you intend to do with the pool, I encourage you to try to figure out what is best for you with that particular item, because in many cases, people are underinsured when it comes to other structures for pools. The debris removal program doesn't include the pool. And if you're going to have to remove the pool, if that's what you end up deciding to do, that percentage of money that you have buried in your policy for debris removal, you may want to consider allocating to the items that fall outside the scope of what is included in your debris removal program. So, for example, if you allow the debris removal companies to come in and they consume all of your insurance proceeds when they remove your structure, and there are items that fall outside that scope, and you no longer have any more money to pay for the removal of that particular item, you will find yourself in a situation where you are paying out of pocket for debris removal. The other option is to collect the debris removal money, pay for the items that are outside the scope of the debris removal program, consume the money that you have in your policy for that debris removal piece of your claim. And then when the third party comes in to do the debris removal and they submit an invoice, if there's no monies left in your policy, then that's when the state kicks in and takes care of that expense. So you may want to consider consuming your monies for the items that fall outside the scope prior to the state coming in and removing the debris, and then you're left holding a bag of that you're going to have to pay for down the road. Your landscaping, folks, for all your coverage A and for all dwelling or residential properties policies, you have 5% built into your policy for trees, plants, and shrubs. And that 5% is typically 5% of dwelling. So whatever your dwelling limit is, 5% of that typically gets paid towards trees, plants, and shrubs. And then you have, in some cases, an extended replacement cost endorsement. Now, I've had so many conversations with so many different homeowners who were unaware of what an extended replacement cost endorsement is. Extended replacement cost endorsements, folks, are extensions of coverage that you pay for at the time of the purchase of your policy. And what it does is it gives you additional coverage above and beyond your base limit under coverage A. However, there are different percentages, and each policy responds a little bit differently in the dollars that are assigned to your extended replacement cost. If you do not rebuild your home, that extended replacement cost does not come into play. And I'm going to be very specific on this because this has been a sticking point for many of you. If your loss is not measured above your policy stated limit, which again, folks, is that number that you see on the declarations page under coverage A. If your loss is not measured above the policy limit, it does not unlock that secondary extension of coverage. So it's critically important that you understand how the insurance company is valuing your property, because if they're coming at just under policy limits, it would not surprise us. It is a tactic in many cases, because then they're forcing you to prove that you're owed additional monies, and you have to perform by presenting some form of product that defines the valuation of what it is that you've lost. In many cases, that's difficult for most people to do, and it's a tactic that the carriers use to keep you out of that extension. If you are paid policy limits, and if the insurance company does what we hope they would, is measure your loss up and over your stated limit, the most money, folks, that you will ever get as a check in your hand is your stated limit under coverage A. I'm going to repeat that. The most you will ever get as a check in your hand is the coverage that you have under your coverage A stated limit. That extension of coverage comes into play when you perform, whether you're rebuilding there, rebuilding somewhere else within the US, or purchasing another property of like value. Whatever it is that you decide to do, it does take some strategic positioning on the front end of your claim to get the carrier to buy into what you're attempting to do. So again, I would encourage you, before you start engaging too deeply with your carrier, consult a professional to understand what you should or shouldn't do. Have those conversations, which we're happy to have every day, and give you some personal feedback as it relates to your personal situation so that you understand how to control your narrative as you move forward with your insurance company. There are some policies that when there is a declared catastrophe, that your policy language changes and your coverages change. And I will just use this one particular carrier, which is Safeco. Safeco policies can sometimes add an additional 50%, or in many cases, double your coverage A limit, simply because it was a declared catastrophe by the state or the federal government. So you may want to read your policies in great detail to understand if there is a catastrophe endorsement that changes the valuation of your policy, so that you're not losing any money or leaving it on the table. And then, of course, you have code upgrade for most policies, which is either 10 to as much as 100% of your stated limit. So everything kind of revolves around the stated coverage A dwelling limit. Typically, some of these offset coverages are all percentages of the base limit. And again, happy to have discussions with people privately to discuss their personal situation. Let's go to the next for other cover or other structures. So coverage B, other structures, sometimes State Farm policies are called dwelling extensions, depending on how old your policy is. They are calling them other structures, separate structures. Some deck pages are calling it dwelling extensions. In any case, typically what is included in other structures is the following: garages, workshops, detached fencing, walkways, pools, sprinklers. You get the idea. Now, typically coverage B, again, is always represented by a percentage of coverage A. So using the previous example, if you have a $2 million policy for your dwelling under coverage A, this happens to be 10% of coverage A. Most other structure limits are 10 to 20%, depending on what you paid for your particular policy. Debris removal is also included in this particular coverage as well, because if you have a separate structure, you're entitled to have monies to remove that separate structure for debris removal. And if you're rebuilding that other structure, you also may have some code upgrade coverages, which we'll get into, that apply to your other structures as well. So it's important to know when you're communicating with your adjuster what the structures are and how your property was laid out would fall under the other structures. Now, I will say this. I would say a good 90+% of homeowners in these wildfire events are typically underinsured in this particular coverage, because for whatever reason, agents and brokers, no disrespect to agents and brokers, but in many cases, they don't really understand exactly how the policy responds to these perils when there are massive catastrophic loss. And if you have a $150,000 or a $200,000 pool house, or an outdoor kitchen, or a $500,000 pool house, and you didn't notify your insurance agent or broker to add that to your policy as a separate value, then most cases you will be probably underinsured. For anybody who has a pool, to replace your pool typically will cost more than what most people have in their coverage B, other structure coverage. It's just typically how it goes. So you want to make sure that you're pushing pretty hard for your other structure money. It's not something that typically takes all that much to get you to policy limits on. And by way of being forensically accurate in your communication with your adjuster, making sure that they have a real clear understanding as to what you had on the property. Because remember, folks, you're telling the story to your adjuster, and your entire financial recovery, and I mean this wholeheartedly, your entire financial recovery is going to be solely dependent on the interpretation of that individual's understanding of what it is you're trying to tell them you've lost. That's like me trying to play Pictionary, and I am no artist by any means, and drawing a picture and then putting it in an envelope and sending it to somebody and having them open it and try to figure out what it was that I tried to draw. So you want to be crystal clear in your communication with that adjuster. You want to make sure that they repeat back to you what you've said so that you understand that they understand, because you've got to be very clear and concise in your communication when you're expecting them to place an appropriate valuation on what it is that you've lost. So again, quick overview: garages, workshops, pools, detached garages, fences, and alike would fall under your coverage B or other structures. Moving on to the bane of everybody's existence, which is your personal property. Folks, we're going to get into this a little bit later, but I want to make sure that I touch base now. It is inhumane to expect that you would have to put together a personal property product that would define every single line item of what it is that you've lost and that you've accumulated over the years. I would say 95% of people struggle with this part of their claim. However, I want to just point some things out because I think it's important that you understand from a business perspective why the insurance companies do what they do and not just pay you limits. If I'm an insurance company, and again, I might take some heat for this, but that's okay because I'm an advocate for you. I'm not an advocate for them. If I'm an insurance company and I know that I can only pay you, or I can, my bare minimum is 30% and not more than 250,000 according to the Department of Insurance. Now, of course, some of you have received much larger advances for your personal property. But in general, let's say we'll just use $1 million as an example, and the insurance company pays you 300,000 as an advance. It is a calculated risk and a gamble on their part that you are never going to get your personal property up over to the point where they owe you $1 million on your personal property unless you have some kind of system. And statistically speaking, most families who go into this thinking that they're going to achieve that goal of policy limits, most fall short because you don't have a system in place that allows you to stay on track to better understand how to do that. So it's critically important that you understand, if you're going to move forward and understand how to do your personal property, allow us the opportunity to give you some resources to help you in that. We offer to our own clients, but we're doing it as a courtesy, a couple products that I think you'll find very helpful. You do not have to do line item inventories as it relates to your personal property. Commissioner Laura has forced the insurance companies to accept your personal property in category form, which means instead of having to list 3,000 to 5,000 or 6,000 line items, you only have to put together, I believe now it might be, and forgive me if I misquote this, but it's about 92 different categories, I believe. And a category would be kitchenware, sporting goods, formal wear, and there's a series of categories. And instead of you having to do line item by line item, you're doing valuations per group. And that can be helpful in getting you to the finish line. So if your carrier is requiring you do a line item inventory at the end of our presentation here, I'm giving you some information that allows you to refer back to the 2025 regulatory code or regulations for the Department of Insurance, which forces them to accept a category inventory. But we'll just go through this right now. Some people, and we've seen, are confused by what the sublimits are that are stated in your policy. Sublimits, folks, would apply to business, personal property, watercraft, cash, firearms, sometimes jewelry that you'll see. Your sublimits apply in most cases towards theft, not necessarily towards fire. Now, business, personal property, absolutely, the sublimit is going to apply unless you had a business policy and you were running your business from your home, that's a different conversation. But in general, a lot of those sublimits do not apply with fire. So firearms and things like that are covered under a fire policy for the value of whatever it is that you may have lost. Many of you have scheduled items, which are line items that you've paid additional for to separate outside your budget for your personal property coverage. You have them insured individually because of the value of that particular item. So if you had a Steinway or you had beautiful jewelry, typically most people will separate those high dollar items or artwork so that they have their own value and not consumed in your personal property. If you do not have a scheduled item, then all of your personal property, which is basically this, if you took the roof of your home off and you tipped your house upside down and you shook it, everything that falls out of the home, the garage, the sheds is all personal property. So that can be daunting when you're trying to recover all of that, but that's typically what falls under personal property. And we're going to get into the next slide, and then we'll go into actual cash value versus replacement cost value. So common inventory questions. Do I need to list every item? No, you don't have to, folks. However, they have to accept a line item inventory should you choose to prepare one if you really want to capture your total valuation loss. As an example, for those of you who have partnered up with an attorney who will be moving forward with some lawsuits, in order for the attorneys to really understand your loss, you have to generate something that shows what it is that you've lost, and then the difference between what you've been paid from your personal property policy or your dwelling portion of the policy beyond is the dollar amount, and I'm no attorney, so don't quote me on this, but the dollar amount that you are at Delta, that is the dollar amount that you can technically go after somebody if you choose to engage and you're successful. So the way to do that is to do your line item inventory, should you choose, and that way it records exactly what it is you've lost down to the penny for every line item. For some of you, there may be tax benefits in doing so, so that you really understand what your total loss is. That can be rather taxing and daunting, so I don't know if it's something that you would want to endure, but certainly if you chose to do so, the insurance company has to accept it. So what is holdback and how does it work? Many of you, if not all of you, have replacement cost policies. And holdback is the depreciation amount that they hold back when they apply depreciation to your personal property. Let's just go to the next slide and I'll get into it a little bit more, I believe, in this next one. No, let's go back one more. I apologize. Thank you, Chad. Okay. So replacement cost. Here's the formula. Replacement cost minus depreciation equals actual cash value, or ACV. Folks, if you read your policy, you'll see that the insurance companies owe you actual cash value until such time you replace the item that was lost. Show them the receipt that you've replaced the item for the value of the item, and whatever depreciation they applied to that particular item, they then reimburse you back. That's called recoverable depreciation, or otherwise known as depreciation holdback. A quick example to that would be this. Let's assume you had a couch. The couch was 5 years old and you spent $10,000 on the couch. The insurance company will go to their magic database, where they get it, I have no idea. And they'll say, this particular couch has a 10-year lifespan. And since it's 5 years through its 10-year lifespan, we're going to depreciate the couch 50%. And since they spent $10,000 on the couch, we're going to give them $5,000 towards that couch. And when they show us the receipt that they've replaced that couch for $10,000, we will give them that $5,000 depreciation holdback. Now, folks, I want you to think about why they have you do that, because they know statistically you are not going to replace 100% of your personal property. So if you don't get to your policy limits, the chances of you replacing 100% of your items is not even 0.1% because it doesn't happen. So there are strategies and tactics, which I'll get into right now. Actually, I think it's a good time of how you want to approach your personal property quickly. Since the insurance company owes you the actual cash value before you replace your items, here's the goal. Depreciation is now based off age, condition, and what they call useful obsolescence. It used to be based just off age, which isn't a fair representation for the insured. A quick example of that would be if you had a guest room and you had beautiful brand new furniture in the guest room, and you've had that same furniture in the guest room for the last 10 years, and you've had one guest a year, that furniture's only been used 10 times technically. So is it fair to depreciate furniture like that by 10 years when it's only been used 10 times? Well, what's the lifespan and what's dictating the depreciation on that furniture? If it's the usefulness is, let's say, it has to be used every day, 365 days a year. Okay, well, if it's used one day a year, that means it has 300 lifetimes left in it. So controlling the depreciation is critical in your overall recovery, which is why you need to be very careful about how you approach your personal property. So the goal is this: never ever submit an incomplete personal property product to the carrier. Don't do it in stages. Wait until you have completely finished your personal property product, because you want to make sure that you are accurate in your assessment of value, number one. But the main goal, folks, is that let's just say you had $1 million in coverage. You want to get so far above that $1 million and what it would take to replace the item. Because remember, you have a replacement cost policy. And what that means is what it takes to replace the item in the market today. Doesn't mean what you paid for it back 5 years ago, because you may have something that appreciates in value, which is critical. You want to make sure that you're assessing the value of your different items appropriately. So if you have $1 million loss, you want to make sure you blow past that $1 million so far so that when the insurance company applies their depreciation, remember, the actual cash value is what they owe you. You want that actual cash value dollar to be at or just above that policy limit for your personal property. That forces the insurance company to cut you a check for your entire personal property limit. You do not, folks, I cannot stress this, you do not want to get into the receipt game with the insurance company, because I promise you that will take years of your life, and there will be absolutely no way for you to manage what it is you're purchasing and replacing and sending invoices. It's going to be a nightmare. So focus on trying to get yourself far above that personal property limit so that you can consume that depreciation that you know they're going to apply, and then force them to cut you a check with what the valuation is on the actual cash value. Let's go to the next slide, please. Some tips and tricks, I guess. It's really helpful, folks, if you guys always have a pad and pen next to you, because as you go through the day or you wake up in the middle of the night and your brain is just reeling with things that you may have lost, it's really important to have something next to you just to get it off and just write down what you may have lost. No rhyme or reason, just make sure you get it on paper so that you can kind of start formulating your loss list. Draw each room. Now, I will say this. It is important that you understand how to take a look at your home. I would encourage you, and I'll just, again, just a different tip. If you change your visual perspective on how you're looking at your loss as a whole, you change your mind's eye, because as we start traveling through our home, you have a pattern, right? You park here, you walk through this door, you put your keys here, you grab this, you put your jacket, whatever. You have a pattern. So as you're trying to walk through your home, the only frame of reference you have in your mind's eye is that pattern of how you walk through your home. So things that are unimportant to you, that are sitting in your blind spots, are going to remain in your blind spot unless you change your perspective. And so what we recommend when we say draw out each room one by one, change the perception and Draw each room, but from an aerial perspective. Look down onto each floor. Draw an outline of that floor from the aerial perspective and draw where each dresser and the closet and all of the areas that you know you had personal property in are located in the room. And then if you really want to get even more forensic, take that room and break it into 4 equal small quadrants. And then take your mind's eye and jump into one of those quadrants and go up the wall and down the wall and across the floor and just in a clockwise motion, just spin in one little circle in that little quadrant and capture everything in that quadrant, and then go to the next quadrant and do that through each of your rooms. And I'm telling you, folks, you will capture far more of your personal property because you're forcing your brain to change how it's remembering what was in that particular room. It's a fantastic tool that I encourage you to use. It really will help you overall. And again, don't forget what's in the dressers and under the beds. This is also a great tip. If for those of you who have ever celebrated Christmas, Easter, Thanksgiving, birthdays, whatever this celebration was, in your home, and you've had guests and friends that were there, they all probably took pictures. We all have smartphones. Everybody has selfies, and everybody's taking a million pictures. But in the background of that picture, folks, from that event is your personal property. And not only is there personal property in the background in that picture, but also the cabinets potentially, and the countertops, and the flooring, and the crown molding, and the things that you may need to help when it comes to explaining to your adjuster what your home consisted of. So you might want to consider opening a Dropbox app and download all of these pictures from friends and family and give everybody the link and have them start searching their archives and dump these pictures into this Dropbox file so that as you go through, it will help you. And if necessary, if you're doing this on your own, and you're trying to communicate with the adjuster and they want to sit with you and try to knock your entire inventory out in an hour, at least you have something to reference and go back to. So again, the photograph, the documentation, the Dropbox, it's a really helpful tip in getting others who want to help you and allowing them to do so. Let's go to the next slide, please. Thank you. All right. Now we're going to jump into your loss of use and your housing. Many of you have struggled with this because either you haven't received the money that you're supposed to from the insurance company, or the inventory that you're trying to find is absolutely non-existent given the number of homes that have been lost, or if it is available, the cost associated with that particular property might be far outside the reach of what your policy might cover. So we'll just kind of go through these. Again, folks, I won't go into too many specifics on this call, but if you have questions about your housing, there is a lot of creativity that can be applied to these particular coverages that I encourage you to have some high-level conversations about because it might change how you navigate moving forward with this particular coverage, and we can give plenty of options. And I'm happy to do so on a one-on-one as it relates to you personally. But you have 2 different types of coverage typically built into your policies. Some of you will have what's called ALE, and some of you will have the language FRV, which is the fair rental value. ALE is basically your additional living expenses. That will include your temporary housing expense, the cost of rental furniture. I would encourage you folks, there is a great app that I always encourage people who have suffered major loss and have to travel around to use. It's an app called Mile IQ, MILE IQ. And for those of you who have Apple, it's in the App Store. This Mile IQ app is great because as soon as you get into your vehicle and you start driving, it tracks the number of miles that you drove. So if you are traveling out of the area and you have to now travel into the area in order to go to your property for whatever reason, and you are constantly doing so, and you're adding 10, 15, 20 miles to your daily transportation that you would not normally have incurred. That Mile IQ app is fantastic because at the end, you can either swipe one direction for personal, you can swipe another direction, and it puts it into a business file. And you can apply that mileage and submit that mileage for reimbursement at the standard mile rate at the end of your claim. Look, it might end up being virtually nothing. It might be from a couple $100 to, a few $1,000s. But nonetheless, your increased fuel cost, your increased mileage, you're entitled to be paid for that. And you should record that accordingly because, look, if they owe it to you, you should be paid it. They also owe you for animal boarding. So let's say you're having a very difficult time right now and you're staying in a hotel or you're staying in an Airbnb and you have a dog or cats or whatever the case might be. The insurance company is obligated to pay for the housing of that animal. Along that same line, if you have an animal that is staying with you at a family or friend's home, they are entitled to be paid for housing your animal. So if you were to call your local boarding and find out what your size animal would cost to board and feed for a day or 2 days or a week or whatever, you could make claim for that against the carrier for the party that you're staying with for them to be reimbursed and taking care and housing your animal. But many insurance companies don't express that to you. You are also entitled to have friends and family be paid while you're staying with them as well. You would just generate a lease. You can go to Staples or Office Max, and they have pre-made lease agreements that you can fill out for months, the term of the time, whatever it is. It's very simple. And if you submit that to the insurance company for a reasonable dollar, then that party that you're staying with can be paid for your additional living expenses. Again, I'd be happy to go into specifics on the pros and cons of doing that. The party will be taxed. They will be 1099. That's a different discussion to have. But nonetheless, everybody's situation is a little bit different. And then, of course, ALE is typically driven by either a dollar amount or an amount of time. And right now, folks, you have 36 months available to you per the new Department of Insurance regulation, with an additional 6-month potential extension should there be an extension needed if those delays that were caused over the previous 3 years were not caused by you. If they were outside of your control and it caused you an additional delay, you have 3.5 years technically for housing. Now, let me not confuse you. If you have a dollar amount for your ALE, that does not mean that that gets tripled. That means that whatever the dollar amount is, that's the only dollar that they're contractually bound to pay you. So you need to be careful about what you're consuming each month to make sure that you have enough money to sustain you for however long you believe you are going to be displaced. I think we can all agree to think that you're going to be back into your homes. And I hate to say this, but it's the reality. And I much rather be real than not. 3 to 5 years, I think, is a pretty aggressive timeline right now, just because of the scope of the damage overall. So I think 3 years is going to be pretty close. Fair rental value means if you have that available to you, it just means what your home would have rented for at the time of the loss. So whether you can go to Zillow or Redfin or whatever that may be, put your address in. If you kind of want to get an idea of how they're generating that number, it will show you what your home would have rented for. And that's a baseline that you can use in your negotiations with the insurance company for what it is that you're entitled to. Now, what I will say is this. As it relates to your housing, folks, you are entitled to maintain your normal standard of living. So if you are in a 5,000 square foot home in Palisades, you do not necessarily need to take an 1,100 square foot condo unless that's what you choose to do. Do not let the insurance company pigeonhole you and force you into housing that you are not going to be comfortable in for the duration of the time you're going to be displaced. But again, folks, there are so many different options to weigh as it relates to your displacement, your housing, where you want to go, how to spend that money. And I'm more than happy, and as is everybody on our team, to have these higher level conversations as it pertains to you personally. And also, carrier does owe for increased costs due to limited housing within reason. So that's not something that typically gets excluded. Next slide, please. All right. How do I ensure that I don't leave money on the table? Well, that's a topic every single day. First and foremost, folks, don't talk to the insurance company about what your goals are. You have to understand something. We are licensed to protect you, and we're your advocates. We're holding them accountable. Your adjusters, although they're not bad people, do not work for you. They work for the insurance company. They are either employees or they're third-party vendors, which are independent adjusters who have zero authority to make any decisions. And whatever discussions you have with your independent adjusters, folks, I would just let it go in one ear and out the other, because they're not authorized to give you any financial commitments. That all comes from management. They are basically, for lack of a better term, a drone gathering information, sending it up the chain, and then the value engineering takes place once management receives their report. So again, as I mentioned earlier, your entire financial recovery is dependent on the interpretation of your loss by that one individual. So make sure they understand what you've lost. So you don't want to telegraph your position. You want to keep that close to yourself, because you want to be able to navigate your options and kind of navigate through the language of your policy and figure out what you intend to do. And the more you disclose, the potential of them putting the roadblocks in front of you becomes greater and greater. Understand where the landmines are. Don't step on them. And the only way that you're going to know that is you have to understand your policy, folks. So first thing that I would recommend anybody do when you start communicating with your insurance company is the following. In writing, please request a certified copy of your policy. The certified copy is the latest version of your policy with all changes that have been made to any of the language within the last 12 months. And in many cases, we get these one-page inserts from our insurance company. It says, this is not a bill, and we just discard it. But folks, the reason we're getting that is because something in that language of that particular part of the policy, that particular endorsement, whether it's dwelling or personal, whatever it is, something changed. And that's why they're giving you this, this page to take your old page out of the policy and insert the new, because something changed in the way that it responds, and you need to know what that is. So in writing, in an email to your adjuster, request a certified copy of the policy. It will come to you electronically. Typically, it'll say certified, and that way you know you've got the latest version of your policy / contract with your carrier. Meet with a claims consultant. Explore your options. An attorney or a public adjuster are the two entities that can actually represent you by law in the state of California. Agents, brokers, contractors are not allowed to step in and negotiate the settlement of a claim. Only an attorney or public adjuster can do that for you. So it doesn't cost anything to have a conversation with this, folks. In fact, the more educated you are, the better the decisions are that you're making, the more strategic you are in your approach. And most important, at least from my perspective, your anxiety levels start to drop, because the fear of the unknown is what drives a lot of the anxiety that we're all experiencing right now. And the more control you have over that by way of being better informed, your anxiety starts to drop. And now you feel like you're in more control of your situation and you're making better, more informed decisions. So I encourage you, reach out and have a conversation. Do I rebuild? Well, that depends on your overall goal and how the policy is going to respond to that. So again, going back to those options, rebuilding on site, rebuilding somewhere else in the country, and purchasing another like type property of equal value minus the land. I've had many discussions with people, and we have to take a lot of different factors into consideration to see if it makes sense to rebuild or not. And I think until you have all the information at your disposal, it's a little difficult to determine if you should or shouldn't rebuild. I think a lot of the coverage and what you have coming in is going to dictate what your path of recovery is. If you have a mortgage, or do you have a mortgage? If so, what is the balance? It may play a role. So folks, excuse me, it will absolutely play a role in your recovery because the bank owns the property. Your financial institution is the owner of the property until you pay it off. So, like I mentioned earlier, you don't want to just rush to pay off your mortgage if it doesn't make fiscal sense. An example to that, there might be a property that you may have $1 million balance on your mortgage and your home is gone. Now, depending on the lot and depending on where it is, of course, this is a broad statement, but if you could not sell the dirt that your home once stood on, and I hate to be so direct, but folks, that's just the reality of what it is. You're looking at paying the mortgage off, but the mortgage that you're paying off is you're paying off the dirt. And in the neighborhoods that you are currently in, some much more compromised than others, it may not make sense to pay off the mortgage if you're paying for the dirt, which is half the value of the balance of your mortgage. It just doesn't make sense. So you've got to figure out what's the best fiscal approach to what it is you want to do. And I guess my advice would be, which is incredibly difficult to do, folks, and I admit this, it's hard to remove the emotion from the decisions that you need to make. And it's critically important that the intellect be driving the emotional component, not the emotional component driving your intellect. And so the more informed you are, the more you have your numbers laid out on the table in front of you, the better that intellect can start making the proper decisions. And now you're not being overridden by your emotion. What are the restrictions, if any? Well, the bank may have a role in what they do and what they want. It's their asset. They may want it built back. And if so, they may have some very specific restrictions that are placed upon you, which may force you down that path. So you certainly want to reach out to your financial institution and ask them if there are any requirements of you in this event that you're going to have to follow, because that might dictate your path. Code, does it transfer if you don't rebuild? It's important to know. It's important in how that might affect your recovery. So folks, code is a use it or lose it bucket of money, as we like to call it. And if you don't perform and if you don't bring your property back to pre-loss condition and rebuild something new in today's building code for this, for the time now, if you have a home that was built 50 years ago, obviously code is very different today. So code comes into play when you perform. It's not something the insurance company pays you in advance. It is a use it or lose it bucket. It will always come into play. It can be transferred to a purchase. If you're buying a property that needs code-related upgrades and you can prove that your home would have required X, Y, and Z code upgrades, and the X, Y, and Z related to X amount of money, you can transfer that code-related monies into the home that you're purchasing if it's of like value, and vice versa if you go to rebuild anywhere else on the country. Now, some policies dictate that you cannot move your code-related monies to a rebuild elsewhere, but I believe that you could offset that with the 2025 regs, that you can move your monies to wherever you need to move them should you choose not to rebuild on site. Should you buy instead? Folks, that's another really difficult question based off how all of your coverages combined will respond to this event. Understanding what your out-of-pocket may be to pay off the mortgage, what your net recovery would be. It requires a little deeper conversation to run numbers and determine if it makes sense or not, which again, folks, we're happy to do with you, because the more informed you are, the better your decisions. If I buy instead of rebuild, how do I structure the deal? What upfront commitments are needed? Well, that's a good one. So remember, you have an extension of coverage, and that extension of coverage comes into play when you perform, but you first have to make sure that you've got the carrier committed in writing to the dollar amount that you're entitled to. You cannot either enter into a contract for rebuild without knowing what your insurance company is committing to in writing, and you cannot move into a purchase of a property until you understand what your insurance company is committing to. And so getting them committed in writing is the first step. And then once you decide what you choose to do after you run all your numbers, and you intend to purchase another property, you must get in writing what they are going to do with that extension as you move forward with your purchase. And structuring that communication in the beginning of your claim is critical because you need to control your narrative, folks. I cannot stress that enough. You do not want the insurance company dictating to you. You want to be dictating to them and forcing them to be reactive to your position, not you reacting to theirs. And the only way to do so is by taking control, because remember, this is your claim, this is your money, this is your home. They're not your friends. You're not inviting them over for a barbecue when you're done. You need to be assertive in your approach to this. And so depending on what it is you choose to do, you have to understand how to trigger that contract to respond to that particular goal. And again, we're happy to have that conversation and give you some deeper, greater input on that. Next slide, please. As a courtesy, we've listed, and this is all recorded, so you can certainly get a copy of this, but I thought it was important. You can certainly go to the Department of Insurance website as well. But these are the new 2025 regulations that the Commissioner Laura has imposed upon the insurance companies that provided policies here. I'm not going to go through all of these, but the top that you would want to be concerned about would be that the insurance company cannot dictate to you that you are obligated to do a line item inventory. It must be a category inventory. It can be submitted in any format that you choose. They have to cover at least 30% as an advance against your personal property, up to a maximum of $250,000, and that they have to give you 4 months advance against your loss of use or your housing fair rental value, whatever that dollar may be. So those are the ones that I think are most important that will affect you right now. But I would encourage you to go through the website, get the 2025 regs. Let's go to the next slide, please, because there's quite a few bits of information that you should be aware of. So you are making sure that you're holding your insurance company accountable. And the next slide, please. I've also included, you'll see at the very end here, the Fair Claim Settlement Practices regulations. Folks, I know it is incredibly frustrating, and I think it's important to set the appropriate tone for what you can expect as it relates to your adjusters moving forward. This is not meant to slam the insurance companies or slam the adjusters. It's just the way that the industry works. It is not uncommon during the course of your claim to go through and rotate 4 to as many as 7, sometimes 8 adjusters in the course of your entire claim. I cannot stress enough to you that everything you do, please do in writing. Do not text with your adjuster. It doesn't make it to your file. If you have a phone conversation with the adjuster and they're just spewing a bunch of different things to you that you're a little concerned about, memorialize that conversation in a recap email so that you're capturing that conversation in writing and you're sending it back to them as a recap to make sure that that is making it into your file. Because if that adjuster does not properly document your file and they've made a bunch of commitments to you, and then all of a sudden Jim's gone and now Joe's calling you 2 weeks later and you're waiting for a check from Jim, and Joe goes, hey, listen, I don't see anything in the file that says Jim was going to be cutting you a check. You're starting all over again. So please, folks, document your own file to make sure that you are capturing that communication in case that event takes place, which I promise you it will, and you're protecting yourself. But when they delay in responding to you, you can refer to the Fair Claim Settlement Practices regulations. That is the code by which the insurance adjuster is obligated to communicate within. They are supposed to respond to you within 15 days of any correspondence requiring an answer. The reason this becomes important, folks, when you're documenting your claim is when you start getting closer to the end of your claim and you have almost consumed all of your ALE monies or your fair rental value monies, and you're nowhere near where you need to be, or you're just getting close to being able to finish your project, if you have documented clearly the delays caused by the insurance company, which then acted as a ripple effect that caused you delays because you didn't have the appropriate information from them to make commitments to others, because you need that communication from them, and you can document where they created these delays, you may very well be able to go back to them with your timeline that you've created to say, on this day, you took 28 days to get back to me, you violated California code, blah, blah, blah. In this particular email, it took you 45 days to get back to us. And so as you start to accumulate all of these violations and the days that they've added to your claim, you might very well be able to ask for an extension of coverage or time in your housing. We've been very successful in getting those extensions covered. I would encourage you to document your claim accordingly. Now, this has been a conversation, a topic of conversation for many of you. Should you opt in or opt out? Now, I've heard a lot of different examples of what is taking place in a lot of these communities. One person takes control over the block, everybody kind of opts in or they opt out, and then they bring in a particular contractor for a bid and give us a bid for all 10 homes. I would say, folks, it really depends on what is in your best interest, what you have for your policy coverage. There are so many scenarios that that kind of drive your opt-in or opt-out. It's not a real easy blanket statement to give you an answer, should I opt in or opt out? Pool becomes an issue, basements become issues, your particular landscape, retaining walls and things become issues. And so just be very careful about what you're doing. If you decide to opt in, you want to make sure you are engaged, because when they remove that footprint of what it is that you've lost, folks, you also have to remember they're going to come in and they're going to scrape the dirt. Now, what we've seen in previous wildfire events up north is that they will scrape 3 to 6 inches, but they don't take 3 to 6 inches. Sometimes they take a whole bucket. Sometimes they take 12 inches and they scrape the surface because they want to test one time and make sure that there's no contaminants that leached into the soil. But you've got to remember that somebody has to backfill that when you go to replace your home. So you want to be cognizant about what it is they're removing. You also want to make sure you read that fine print on your opt-in, because they are holding themselves harmless should they create any additional damage. So for those of you who have some beautiful custom long driveways to your property, there's a whole opportunity for them to create some pretty significant damage as they're trucking that heavy equipment down that long driveway to get to your footprint of what you once had. So again, take a look at your property from an objective perspective and say, if I had some heavy equipment coming through here, what could potentially be damaged that I'm going to be on the hook for, number one. Does it make sense? Does it not? And again, we can have these conversations one-on-one, and we're happy to kind of lay out all the options. But in many cases, it makes sense to opt in and then pay for the things that you're going to need to pay for that are outside that scope, so that you don't get caught holding that empty bag and get caught with an expense you weren't expecting. Next. All right. So folks, we will be happy to offer you a whole house guide should you want. And if you send an email in requesting it, a whole house guide is what we typically give to our clients to help jog their memory for what it is that has been lost in their home. It's about 4,000 line items. It's what you typically find in a home. It goes room by room. It is not meant for you to look at and just check the box and really just kind of take this and put it on your personal property. What it's really meant to do, folks, is help jog the memory. So if you see something that may be an associated item that you connect and you go, oh, I did have this and I did have that, it's really meant to help jog that memory for those who are struggling a bit. I'm also, and we're also, happy to provide you with a sample of a category inventory product that we would typically prepare for a client. It will help you understand your formatting. It will help you understand the level of detail that will be required. And it gives you a baseline that you should try to follow as best you can. And that is we're happy to pass that along to you. If you'd like to send us an email, send me an email. There are some general emails as well that you can send the request into, and we'll be happy to get that out to you. I'm going to jump in and grab some questions now, folks, and I apologize if I'm looking to the left, but my screen is over here. Question 1. For contents, does the argument that the insurance company set the policy limits and the homeowner honor the contract each year by paying the premium, is it bad faith by the insurance company if they do not pay policy limits for contents? No, I can't say. Well, look, I'm going to answer it from a public adjusting perspective. Robert, I'm not going to answer it as an attorney because I am not. It's not bad faith if they don't pay because they are forcing you to perform. And remember, it's not their obligation to prove to you the value of a loss. They're only providing the dollar amount for which they owe you up to. It is your obligation to prove the value of your loss to them by way of producing a product that justifies the valuation of what you say you lost. So they don't know what you've lost. They don't know if your home was almost empty or if it was packed to the gills. So they're always going to give you, a percentage of your recovery, and then they want to see how you perform because that's the only way that they can control their liability and their exposure. Now, again, there are some insurance companies that have paid close to limits if you're heavily underinsured or pretty darn close to limits, 80%. But you're still expected to perform to some degree. Can my broker or agent help me with my claim? And are they allowed to if they are not an adjuster or attorney or licensed professional? No. So let me explain why that is. The Department of Insurance is the governing body that oversees the insurance activity here for the state of California. In the same way that your insurance agent is licensed and bonded and background checked, and is issued their license by the Department of Insurance to sell you the product, we are licensed by that same division with the same requirements and the same restrictions, the same background checks and the same guidelines. And our licensing is to negotiate the settlement of the product that they are selling you, the insured. In the same way, I cannot sell you a policy. They cannot settle a claim and get involved. Those two paths should never cross. So to answer the question, no, they cannot support you in your claim. And it doesn't matter how close of a friend they may be. Don't put too much weight on your agent or broker. The insurance company is offering to send me partial payments. How does that impact my claim? If I accept a check, can I dispute the claim amount later? So the advances, folks, again, as I touched on earlier, are the contractual obligation that they have to you. But you have to understand what comes with the advance. Do not get seduced by the advances because everybody thinks, oh, my insurance company is really stepping up and they're taking care of me and they've paid me these huge checks. Well, but they don't tell you what comes with the check. Your clock starts ticking the moment you accept the advances that they're offering you. And you have a clock that's ticking against your housing when you have nowhere to go potentially, and you have no path forward with your recovery because you can't start doing anything on your lot because you don't have any debris removed. So just expect that as soon as they issue those checks, which they're entitled to do, your clock is ticking, which means your time is just being consumed without you being able to do anything to perform to move your claim forward. So just be careful and don't be seduced by the advances, folks. They're obligated to do it. I can't tell you how many people I've talked with that said, oh, they stepped up right away and they put me in housing. Well, they're supposed to do that. So they're not doing anything special. They're not stepping outside the box. They're doing what they're contractually bound to do. If I don't agree with my adjuster's valuation, what are my options for disputing it? Well, again, it's their interpretation of your loss, folks. So the onus lies on you to prove to them what you are owed. And the only way to do so is either by hiring a professional who understands the language and prepares the product in the language of insurance, which forces the insurance company to respond accordingly. And there's very specific software that we use. It's what the insurance company uses. It's what we use. It's called Xactimate. It is the language of insurance, and standard contractors typically don't use that software. And so a standard estimate for a replacement cost on a home, ours might be 75 pages in length, and a standard contractor's estimate might be 30. So there is a huge forensic difference in the accuracy and the level of detail in these estimates. And that's what the insurance company wants to see, is that level of detail. So I'm cautioning you, if your contractor is going to prepare an estimate, just be prepared that there will need to be multiple revisions of that product in order to satisfy the insurance company's request for information. So that's going to be difficult, but it can be done. If the insurance company sends an engineer or consultant, do I have to accept their reports? It's not a matter of you accepting it or not. You always have the right to hire your own independent party professional to offset the position of the insurance company. Because remember, folks, anybody that is sent your direction by the insurance company is being paid by the insurance company to perform the task for which they were hired. So you don't have any say-so in that product. It is not your product because you didn't pay for it. So if you are in a home that's been smoked and you want to try to set your tone with the insurance company, and you want to reach out and pay for your own certified hygienist to do the testing and get the lab results and get the remediation report that shows what should be done based off the level of damage in your home, that is your data, your report that you own. It has not been paid for by the insurance company, therefore they don't own the product, you do. But as soon as you deal with one of their experts, they do not have to share that report with you because it is their work product. So just be prepared to get some pushback. And also, you're all entitled to request all of the contents of your claim file at any time in writing. So if you're getting down the road and you're getting a little frustrated and you've been through multiple adjusters, I encourage you to request a copy of all of the contents of your claim file so that you can see how your claim is being documented. Now, they don't have to give you some of their work product that they paid for, but at least it will give you a pretty good overview of how accurate or inaccurate your file is if you're starting to run into some trouble. Next question. If the insurance company sends an engineer or consultant, oh, sorry, I just read that one. On a rental dwelling policy, can you get 30% of personal property without ever providing an inventory under California law? Also, is loss of rents limited to 12 months regardless of disaster declaration? So on a rental dwelling, and if I'm understanding the question, you own the rental dwelling. And if you have coverage for contents in the rental dwelling, you may or may not be entitled to 30% because it depends on the value of what it is that you have. So for example, let's say you had a rental that you owned and you're the landlord and you have $50,000 worth of personal property coverage. Well, did you furnish the entire rental? That's a different discussion. If you did not furnish the entire rental and then you've only applied or provided appliances, a refrigerator, washer and dryer, a stove/oven, which could fall under personal property. If they know that you didn't furnish the home and 30% of your 50,000 is 15,000, they might question whether or not you had $15,000 worth of personal property in the home that you were providing for rent. So I would have to say, I think it's on a case-by-case basis. The scenario would have to be a little clearer for me to give you a better answer. And the loss of rents is limited to whatever the contract is that you've entered into. If it's 12 months, if it's 24 months, whatever that dollar amount or whatever that timeline is, or whatever the dollar amount is, that is what you are entitled to. So you have to go back and refer to your declarations page. That is the contract you've entered into, and that is what they are going to adhere to. I hope that answers the question because there's a little bit more to that answer. If you choose to live in another home you own until you replace or rebuild the home you lost, can you rent to yourself and be reimbursed under ALE? So folks, That's one of the tricky ones. Short answer would be yes, there are ways to do that. Long answer is you're not supposed to profit from a loss, technically. And by way of you paying yourself in your rental, you're technically profiting from a loss because that money is going to you. Now, I think every single scenario is a little bit different. If there is absolutely nothing available and you have an open discussion with your adjuster, if you feel that you can, and you have that discussion about what it would look like if you were to rent that property, excuse me, I believe that you are better suited trying to create a barrier between yourself and the property, should you decide to go down that road, of which right now I don't want to give you specifics, but if you want to reach out independent, I am happy to kind of go through and give you some scenarios that we've seen in the past that other insureds have opted into. And I think if that scenario matches your situation, certainly at least we can give you some guidance and advice on that. But based off the fact you're not supposed to profit from a loss, I'll leave the answer at that. And that looks like that is the last question, folks. So I just want to thank you all, and I'm sincerely sorry that we even have to have these events every single week. You know, it is with a heavy heart that we have to do these. We don't like doing them, but we hope that you find some value. Again, we're here to help in any way that we can. It doesn't cost you a thing to have a conversation with us and the team. We're here to help you. We're high-level experts as it relates to insurance and navigating the complexities of contracts and giving you strategies and tips and tactics. And we hope sincerely that you reach out because we are here to help. First and foremost is to educate so that you can make better decisions that are informed decisions. So with that, I thank you all, and we'll see some of you next week. And thank you again for joining. We appreciate it. Take care.